Here's my analysis of the current liquidity situation, the risks looming today, and the investment pockets for 2026. Let's start with the macro context, or the triple threat. You are correct to feel that December 10th is a pivotal point. The interaction between the US Fed, the yen, and the AI narrative is determining the global liquidity flow that trickles down to space. Well, let's start with the Fed decision. Well, it's official. The Fed has cut rates by 25 basis points. Why this matters for space, you may ask? Well, this is the lifeline the industry needed. Space is capital intensive, so we run on debt. This cut immediately begins to lower the pressure on venture debt and equipment financing. If you're wondering about the immediate impact, well, we're getting the sugar rush we predicted. Capital is unlocking. Okay, while this is good news, do not mistake it for a cure-all. A single 25 basis points stops the bleeding, but it does not fix the solvency crisis for the startups that are already out of cash. The zombies are still in danger, but the strong just got cheaper access to capital. Second, we have Japan reverse carry trade, the ghost in the machine. Next week, December 18-19, the Bank of Japan meets, and they are expected to hike rates. Up until now, investors have borrowed cheap yen for decades to buy high-growth US assets like tech stocks and crypto and such. This is the carry trade. However, as Japan raises rates, investors have to sell those US assets and international assets to pay back their yen loans. We saw a preview of this back in August 2024 when an unexpected policy signal came from the Bank of Japan which suggested future rate hikes. This caused the yen to spike and market crashed. Next week could be round 2. This will impact the space sector. You see, this selling of US and international assets and pumping the liquidity into Japan to generate the yen needed to cover positions or hedge against further yen appreciations will hurt volatile, long-duration assets the most. If the yen strengthens rapidly, we could see a flash crash in public space assets like stocks and crypto, which freezes late-stage private funding. Third is the AI bubble, which is the oxygen thief. The issue here isn't just bubble potentially bursting. First, there is the crowding out. In 2025, over 50% of VC capital went to AI. Deep tech funds are reallocating space dollars to compute and energy infrastructure. Then there's the DeepSeek shock. Recent news of efficient Chinese AI models like DeepSeek undercutting prices has caused massive volatility in US chip stocks. Third, there's the liquidity link. AI is a highly leveraged trade. If Nvidia drops 20%, hedge funds get margin called. To pay those debts, they sell their liquid assets, gold, Bitcoin, and yes, their positions in space tech. Now let's move on to liquidity. Are we in a liquidity crisis? Well, the short answer is we are already in a silent liquidity crisis for the bottom 80% of the market. The value of debt has widened. You see, in 2020, you would raise a Series B on a PowerPoint and a prototype. In 2026, you can't raise a Series B without signed government contracts or significant recurring revenue. This has created what you heard me talk about earlier, the zombie phenomenon. Many space startups raised huge cash piles in 2021 and 2022. They aren't dead yet, but they are zombies, spending the last of their cash with no prospect of raising more. You see, we are exactly one macro shock away. If the bubble bursts or the yen trade unwinds violently, the risk-on appetite needed for space investing vanishes overnight. Okay, let's move on now to investment opportunities. Despite the gloom, Smart Capital is deploying aggressively in 3 specific themes for 2026. Theme A would be defense and dual use. You see, geopolitical tension is at a historic highs. Governments are the only customers with infinite liquidity, well, because they can print money. Okay, the play here is startup selling deterrence. Deterrence like surveillance, like electro-optical and synthetic aperture radar technologies like SAR technologies, which are 2 primary methods of Earth observation technologies used in satellite and airborne remote sensing. Other deterrent technologies are technical communication and rapid launch systems. The liquidity profile for the theme is high. The defense primes like Lockheed Martin, Northrop are acquiring these startups to modernize their tech stacks. Now let's move on to theme B, which is the in-space services and manufacturing. And we chose that theme because the space infrastructure phase is maturing. We have cheap launches thanks to SpaceX. Now we need to actually do things in orbit. Now here's the play for the startups. Could be satellite refueling, orbital debris removal, biomedicine research, even data centers in space, and pharmaceutical manufacturing in microgravity. However, the risk here is high. This is where the liquidity gap is most dangerous, but the potential payoff is massive. Now let's move on to theme C, which is the telco space conversions. You see, direct-to-device players like Starlink and AST Space Mobile proved the market exists. The play here is ground segment technologies and antennas that allow standard phones and devices to connect to satellites. This has a massive immediate total addressable market compared to speculative ideas like asteroid mining. Let's move on now to scenario planning. What happens if a full liquidity crisis hits? If rates spike or the carry trade unwinds, the middle class of space startups could get wiped out. In this case, we'll see mass consolidation. Unicorns will buy promising startups for pennies on a dollar, purely for the engineering talent. And there also will be asset fire sales. We could see modern satellite factories and IPs sold at bankruptcy auctions. All in all, innovation will slow, and companies with direct government subsidies has a much higher chance of surviving. Okay, the big question after all this doom and gloom, when will things change for the better? Well, the recovery relies on the IPO window. You see, venture capitalists need to return cash to their limited partners. They cannot invest in new space deals until they exit old ones. The IPO window for space is expected to fully reopen in late 2026 or early 2027. Once we see 2 or 3 major space companies go public successfully, liquidity will finally flow back upstream to early-stage startups. The next 12 months are going to be turbulent. Watch for the yen next week, the Q1 2026 US spending bill, and keep your eye on the K-shaped split. This is the Omar Alayli podcast. Thanks for listening and keep exploring.